Good morning, everyone, and technically good afternoon to everyone on the East Coast. This is Rob Wilson with East Daily Analytics, and we're going to be starting the presentation in just a minute here. While you're waiting, feel free to scan the QR code you see on the screen to get signed up for our NGL Insider Weekly. It's our new weekly NGL newsletter that will be going out again free. Just scan the QR code and that'll get you signed up for the weekly. Again, we'll get started here in about a minute. Okay, it's 10:01, so let's get started. And welcome everyone to our first quarterly NGL-focused webinar from East Daily Analytics. My name is Rob Wilson, and I'll be presenting to you today for about 30 minutes or so, our view on the NGL markets. If you have questions throughout the presentation, you may submit them through the portal and we'll either address them today, or if we run out of time, we will follow up with you after the webinar. Again, if you want our NGL Insider, our free weekly newsletter, scan the QR code there. There's another slide at the back, and that'll get you signed up for our free weekly NGL newsletter. Additionally, I'll be in Las Vegas next week, Monday through Wednesday, with Jack Wexel. If you would like to schedule some time to talk NGL markets with us or just see the data we have available, just reach out to either one of us. Happy to make time and kind of discuss what we have and what we're developing from the NGL product perspective. And speaking of, there are a lot of exciting developments underway within our NGL product vertical to supplement our current products. Those current products are, one, the NGL hub and spoke model, which captures pipeline capacities and throughput for all supply basins and market hubs in the lower 48, namely Conway and Mont Belvieu, as it pertains to demand markets. And we also have the NGL purity product forecast, so C2 through C5 plus by basin and EIA pad. We prefer to look at supply by or through the lens of a basin by basin perspective, but understand that many like to benchmark to the EIA, so we have that data as well. And we also use data through gas gathering and processing systems to better understand NGL production out of plants and down market. This data is warehoused online in our Energy Data Studio. And you can see the NGL products. If you just scan that QR code, that'll take you to the NGL products we have for sign up. Finally, if you're interested in our consulting services, we have a consulting team, Ryan and Nigel, that leverage our database of energy information as well as the analyst team to do custom or bespoke work on specific markets or assets. So that's the commercial piece of our discussion today. Let's get into what's interesting in the NGL markets at the moment. So today, really three things I want you to kind of take away as far as what we'll be talking about. And really what sets the table for NGL growth is Permian growth. Permian growth, we expect, will be slowed by private to public consolidation. We'll still see growth, we'll just see it at a declining rate. And that's very impactful to NGL supply, as you will see. The midstream sector has and continues to do a good job of staying ahead of supply constraints by building more plants, more long-haul NGL pipes, frac storage, and exports. As we discussed in Dirty Little Secrets, the competition to collect NGLs at the wellhead and funnel them down a vertically integrated value chain is intense. And we'll discuss the projects, the ongoing projects to meet supply growth. And finally, we're seeing historic highs in LPG exports, and that's being spurred by international demand growth. So what do we see as far as incremental propane supply hitting the water off the Gulf Coast of the U.S. relative to LPG demand, particularly from China's new PDH facilities expected in 24? What does that mean to price? So first, let's talk Permian. In this first slide, if you've joined our crude or nat gas verticals, you may have seen it, but I think it's an important one. We've gone from about 350 active rigs in the Permian to about 300 today. That is certainly part of the reason we see growth slowing. Really, it's the public company consolidation of fast-growing private operators like the recently announced acquisitions of Crown Quest and Endeavor. And really the primary motivation there, or motivations I should say, are build inventory for the acquirers and via steady or moderate growth, generate considerable or significant free cash flow for debt and equity holders. What you see in the chart is acquired private operator rig counts reduced by nearly 70% in 2023. So generally what we see are public companies that have been pretty darn disciplined to staying or growing within cash flows, generating free cash flow relative to private operators that have been growing a lot faster. And as the public companies have acquired private, that growth has certainly moderated. The second reason we've seen growth slowing is really gas egress constraints. And that's going to continue to be a story in 2024 until the 2+ BCF a day pipeline from Matterhorn comes online in September of this year. So another thing that's helpful in understanding production for the next year out is producer guidance. And this is pretty reliable data because producers, almost all of them at this point, and I know there's a few that report this week, have set capital budgets. They've hedged out a significant portion of their production, and they've guided to growth rates to the street. So take now versus 2 to 3 years ago, when about half of production and rig activity was private, you only have about 25 to 30% of production or rig activity that's private now. So this gives us absolutely very good insight into what we can expect for growth as these public operators guide. What I've highlighted here is a couple of recent acquisitions. Endeavor and Crown Quest have been growing significantly over the last couple of years. They are or will be acquired by slower growth public companies. And the estimated growth from 23 to 24 for Diamondback is almost 3.5%. It's a little above 2% for Occidental. So the impact certainly, like we pointed out, we would expect slower growth. And what this implies about all other operators, and there are a few public operators in there, but they're mostly private, is they would need to grow at about 6.5% to get to our forecasted growth of 368,000 barrels a day, or 6.3% crude oil growth from 23 to 24 average to average. So that's where we stand on the Permian, and because it's liquids focused basin, it's relatively easy to get crude production guidance. What I'll talk through now is how we see that play out across the commodities. So crude oil, dry gas production, and NGL production. You can see it here across the board. And the growth rates are relatively consistent. Two things to remember on growth. One is the shape of growth. So we had a winter storm in January that impacted supply by about 4 to 5%. And that's the dip you see in early 24. Then if you look at the crude oil production or dry gas production charts, what you really see is flat production for the first 6 months. And it could even be a little bit longer. There's some seasonal demand that allows producers or effective capacity to increase going west into Southern California and south into Mexico, which we believe will allow producers to grow before the Matterhorn in service date. But nonetheless, you can see the shape of growth is really delayed, and Chevron and Exxon are a couple public operators that have talked about even a little bit lower supply in the first half of 24 relative to 23 exit, while they build DUC inventories for operational purposes to even out any sort of operational upsets they might have. And then the other thing to really point out here, if you look at the Permian NGL production growth, you can see the supply is a little bit more tapered than growth for crude or dry gas post Matterhorn. And the reason we do that, the reason that we taper supply is because when gas egress is the constraint is relieved, that's going to support Waha prices and incentivize more ethane rejection into the gas stream. Whether or not that plays out is something we are taking a look at. Potentially ethane prices could be a little understated in the forward curve, but let's talk about that. So that brings us to the next slide. It's not you, it's Matterhorn. So what we're showing here is the Waha gas price is the gold line chart, and the Mont Belvieu ethane forward is the dark blue line chart, and the vertical just separates historical versus forward. You can see the ethane forward curve is relatively flat to even contango shaped, especially out in 4Q24. So ethane's not going down. But Waha definitely is going up. The forward curve from March to October, and I think this might even be lower if I refreshed it this morning, is 125 per MMBTU. Waha for December 24 is 292. So that's a significant expected uptick in price. And of course, that's from Matterhorn alleviating gas egress constraints, especially going east. So great, it's not ethane, it's really Waha that's narrowing the frac spread, which is basically just Mont Belvieu ethane minus Waha on a $1 per gallon price equivalency. The frac spread goes down significantly in the back half of 24. And what that does to our forecast is really taper production. You can see it probably even more visibly in this chart than the prior one. We level that off. I think there's probably some upside risk there. Again, that's something we're looking into. Do we actually believe that thing forward, or do we think there's asymmetric risk to the upside there? I would bet the latter, but something we are working through at the moment. So U.S. liquids focused growth is slowing. We've talked about that. We've talked about what producers have guided to, which gives us pretty good insight. The Permian is still leading the way when it comes to liquids growth, and you can see here from 23 to 24 average to average of the 279,000 barrels a day of growth, total NGL growth in the lower 48, almost 200 or 70% plus of that is coming from the Permian, which is why we're spending a good chunk of discussion today on the Permian. One other thing to note, and you can see this outlined, I'm not sure if you can see my cursor, but most of the growth is coming from the Delaware subbasin versus the Midland. We're seeing gas IP rates that are 3 times higher, and so that's where we see most of the growth. And even some producers have talked about allocating more capital to the Delaware. So, you'll often hear us, if you're familiar with East Daily Analytics, when we look at supply growth or change of supply, we leverage the infrastructure in which that molecule is transported to better understand change in supply. What is shown here is a handful of probably 55 or so G&P systems in the Permian, and the y-axis tells you the gas IP rate, MCF per day, and the x-axis tells you the number of active rigs behind these G&P systems for 2024. It's the forecasted rig count we have. And what's interesting here is or I guess really illustrates what the comment from the prior slide, which is systems in the Delaware Subbasin have significantly higher gas IP rates. And that's why we're seeing those systems drive a lot of the growth. And from that gas growth comes NGL production growth. And then the second thing is, and you can see this from our Energy Data Studio just by clicking on the systems, which producers are really driving that growth. So for Western, it's Occidental and Mewbourne feeds their Delaware system. For Targa in the Delaware, it's Conoco and Chevron that are big producers backing those systems. I also highlighted a couple others. Matador and Exxon have their own G&P systems. I didn't show them on this chart, but those systems have filled very quickly, which makes sense because if you're an operator, you own your own G&P, you're going to prioritize that to the extent you can. The Enterprise and Targa Midland systems are not bad. In fact, they're probably the two best G&P systems in the Midland. Targa, backed by Pioneer, which will very likely be Exxon in the near future. Those are good systems. Again, it's just a difference in the sub-basins we're seeing across the board is the higher gas IP rates are in the Delaware. So that's a pretty quick tour through our view of Permian growth, but hopefully get a sense of where we stand. I know from conversations with clients and just folks active in the market, there was a decently wide band, lower bound to upper bound on Permian growth expectations. But hopefully you know where we sit now. That's the plus 368,000 barrels a day coming from the Permian. The second thing is infrastructure, and we spent a pretty significant amount of time talking about NGL infrastructure in our annual outlook, Dirty Little Secrets. So this is somewhat of an update to that. Consistent with the higher gas IP rates, most of the expansion projects or growth capital from a processing perspective is occurring in the Delaware Basin. And the three behemoths that we talked about in our annual outlook, Enterprise, Energy Transfer, and Targa, are capturing the lion's share of that growth capacity. But a couple projects that were announced in 4Q 23 earnings, I've highlighted here with the gold star. Matador is proceeding with its 200 a day gas processing plant expansion, and EOG announced its intent to build the Janus system, which is a 300 MMCF per day processing plant. There is plenty of runway for now as far as gas processing capacity in the Delaware. It does get relatively tight in the back half of 26, but Targa in their 4Q 23 earnings call, which is 1Q 24, 2 or 3 weeks ago, mentioned they're ordering long lead items for their next Permian plants. Energy Transfer said they're expanding existing plants via compression in the Permian and Eagle Ford, which will result in a combined incremental capacity of about 100 to 150 a day. So those expansions don't show up on this chart, but midstream does seem to be doing a good job of staying ahead of the game making sure that any constraints close to the wellhead are minimized. Now, when we hop over to the Midland, I don't think it's any surprise that the number of projects and the number or the volume of expansion capacities is lower because the growth profile in the Midland is lower. So there's even less of a concern of Midland processing, being a constraint. I think we just believe there's plenty of capacity. There have been a few other projects that have been announced: Brazos, Sundance, West Texas Gas, Red Lake expansion, and then the stakeholder Campo Viejo 2 plant. They may be proceeding. We just could not find anything recently talking about the progression of those projects. Have also scanned for air permits and just didn't see much in the way of those projects. So if we missed it, mea culpa, but we haven't seen anything recently on those projects, and certainly it would appear that you don't need that additional capacity anyway. Moving along down the value chain to NGL Permian egress, similar story to GNP. There is plenty of NGL capacity, or I should say, NGL capacity is tight now and will be really until the end of 24. So there's really two parts of this story. One is until Targa's Daytona pipeline comes online, and then you also get Bahia and a few of the other expansions in early 25. It will be tight until then. Once early 25 is here, and some of these larger projects like Daytona and Bahia are online, then we forecast utilization rates in the low 70%. So really no issue getting NGLs out from a long haul perspective post 24. We believe it will be tight until then. Most of those projects, or 1.1 of the 1.4 million barrels a day of wide grade capacity expansions are from Enterprise, Targa, and Energy Transfer. Energy Transfer doesn't have as big of expansions coming online as Targa or Enterprise, but they did announce or disclose in their recent investor deck that they have the ability to increase egress out of the Permian through low capital cost compression projects. So plenty of capacity. We went into more detail and dirty little secrets about why we believe midstream is willing to overbuild, even though that might mean compressed transportation rates until utilization creeps up north of 80%. So if you'd like to discuss in more details why we believe this rationale makes sense, then happy to follow up with you on that. From the NGL frac perspective, this market is tight and it's staying relatively tight. You can see capacity in the red line and our expected or forecasted fractionated volumes shaded blue. In particular, the green dash line is frac utilization rate. It really doesn't dip below 90%. So a lot of these volumes are contracted under long-term contracts. The portion of volumes, usually about 10%, that is fractionated on spot basis, will see upward pressure, or in other words, midstream companies like Targa, Enterprise, and Energy Transfer will be able to charge higher rates because of tight fractionation capacity. And as you can see, that remains the case even after Targa, Energy Transfer, ONEOK, and ET bring online additional capacity. What we had said when we were talking through this dynamic in Dirty Little Secrets is lead time from project announcement to in-service date for fractionators is about 1.5 years. So we expected the midstream behemoths and some others to announce fractionation expansion projects to alleviate the constraint. Remember, there's not a constraint at the wellhead through GNP. There's not a constraint post 24 on NGL egress, but certainly these markets remain tight. And what we heard in 1Q on earnings calls is Targa, again, ordering long lead items for its frac train 11. I do not believe that was FID'd, but they are preparing or planning to proceed with that. And then MPLX did file an air permit, I think it was November or December last year, for fractionation and NGL storage in Texas City. So midstreamers are moving on the need to build out more frac capacity, which, as you can see, we need mid 26 even. You're encroaching on 95% utilization rates. This slide I will go through fairly quickly. It's merely an update to the value chain integration that we've been discussing. I'm not going to talk through all these. This is more of a takeaway. You can read it at your leisure. And certainly if you have any questions on any of these projects, reach out to us. One kind of quietly, or not quietly, I mean, they released a press release, but one thing that was interesting is Enterprise did acquire Western Midstream's interest in Panola Pipeline, which feeds their fractionator 7 and 8 in Mont Belvieu. So Enterprise continues to do everything they can to consolidate the NGL barrel. One other thing that was somewhat interesting is Energy Transfer talked more about storage than I've seen in the past. As we export more LPGs internationally and manage demand domestically, we do believe storage will, it is something that will have heightened interest in the next few years to balance international and domestic demand. And the third thing we want to take time to go through is LPG docks and international demand growth. So just mentioned it, have been getting a number of questions on how tight LPG export docks are. And we do touch on, as we develop products in the NGL product suite, we're looking to move further downstream. Part of that is export capacity and outlook on price. So we'll touch on that as well. So not quite as tight as fractionation capacity, but you do see LPG export capacity get tight in 4Q24 and 1Q25. Seasonally, that's when we see more demand for exports, so it makes sense. And this precedes really the next LPG expansions, which is first half 25 and first half 26. The usual suspects, right? Energy Transfer at Nederland, Enterprise Products at EHT, and then Enterprise Products also has the propane Beaumont Flex facility, which means they can export about 180,000 barrels a day of ethane or 360,000 barrels a day of propane. And as you can see from our forecasted LPG exports, if they use that for propane exports, there's plenty of capacity even into 26, 27. If they use it as an ethane export facility, then it does remain pretty tight out of the Gulf Coast. One interesting thing to note, and Targa talked about this a little bit in their earnings call, which is the ability to export LPGs 24/7 due to the Houston Ship Channel pilots being able to operate 24/7, effectively increasing LPG capacity by 5 to 10%. Targa was the one that the company that really kind of went into what that does as far as benefiting them on the capacity side. But I would be surprised if Energy Transfer and Enterprise didn't also realize a similar upside which is not built into this stack. But nonetheless, we do expect things to be tight through end of 24, early 25. And Enterprise did mention double-digit spot loading rates that they were realizing for spot shipments in 4Q of 23. So expect more of the same in 4Q 24, 1Q 25. Okay, so on to propane price risk and what are we seeing? The propane price forecast is shown in the blue line chart, which is the forward curve, and then the gold line chart is historic spot propane prices plus the EIA forecast. Our view as we dig into this is there's asymmetric upside risk to price. And we're really bullish propane price in 24 because of two things. One is what we spent a good chunk of today talking about, which is there's a governor on US liquid supply. We did not get into OPEC liquid supply, but they are maintaining relatively flat production. I think they said something like 60,000 barrels a day of NGL increased production in 24 versus 23. And then the expectation of sustained domestic petchem demand, and really it's the PDH demand growth from China as they bring on a number of PDH facilities in 24. And really, it's going to be the U.S. that will fulfill that need, given the relatively flat growth profile of OPEC. So when you consider the incremental propane demand from China with respect to propane growth in the U.S., storage really has to meet a lot of the incremental demand that is not coming out of the U.S. that we've seen in recent years past. So again, three main things are Permian growth slowed. That we still have growth, 368 a day. It's less than the over 500,000 of growth we saw from 22 to 23, but definitely moderated. There is tightness along the NGL value chain in long-haul egress pipes and frac, but help is on the way through expansion projects. And then really finally, with the U.S. growth, most of that, because of a lack of significant propane demand domestically, incremental demand is being shipped internationally. So very important to keep an eye on the PDH facilities being built in China. So with that, if anyone does have any questions, I would say because we are bumping up on the half-an-hour marker, if anyone has any questions, I've listed my contact information as well as Christina, who's done a lot of the legwork or the analytics behind this presentation to make this possible. If you have any questions at all on anything we've discussed, or just as importantly, anything we have not hit on that you would like more detail about, do not hesitate to reach out to us. We really love engaging with our clients in the market about what you find interesting as well. And like I said, we will be doing these webinars on a quarterly basis to hit on key points of interest. So what we did today, expect three more of these this year. And again, if you haven't already signed up for our NGL Insider, it's a way to stay kind of in tune with what we're seeing in the market on a week-to-week basis, from a rig flow activity, infrastructure, what we're seeing through the lens of NGL infrastructure. And then we'll have a section where we hone in on a purity product every week. So yeah, please reach out to us. We really appreciate you joining us and making time to listen to our first NGL webinar today. And we look forward to speaking to you soon. Thanks, everyone.